Hello friends, my name is Shanti Dugad and in this video I am going to cover the concept of valuation of bonds. I will explain the basic concept of valuation, and then how do we value the bonds when there is a semi-annual interest payment, what are the factors which affects the bond valuation, and then I will explain the concept of yield to maturity and how do we do the quick approximation of yield to maturity. And the valuation of preference shares and equity shares, I have created two separate videos, so you can refer to that if you wish to understand those concepts. The valuation of bonds is basically the value of any asset what you buy is equal to what return you get or generate from holding that asset and what risk you carry to hold that asset. When you combine the risk and return profile of any asset, you derive the value of that asset or the price of that asset. And what is risk? What is return? Return is the basically expected outcome or cash flow from the said asset on periodical basis, which the investors get for holding that assets or for owning that assets. And what is the risk? Risk is basically the chances that the expected outcome will not occur or that cash flow expected will not be realized. So it is basically the variability in the return, which is denoted by the time value of money, which we calculate by factoring the time value of money, and the expected return is discounted by that rate. So higher the risk, the discounting factor will be higher. So the future cash flow received or the expected outcome will be discounted at a higher rate, and the value of that asset will become lower, all other things being equal. So we can put it in a mathematical formula, very simple way. This is C1 is the cash flow of year 1 divided by 1 plus k raised to power n power 1, sorry. So k is basically the cost of capital, or you can say expected rate of return of the investor at which it has to be discounted, and C2 is the cash flow of year 2, so that gets discounted by 1 plus k raised to power 2 and so on till the nth period. So now alternatively, when we can put this formula also in this fashion, that V equals to C1 times PVDF1. So cash flow of year 1 is multiplied by the present value discounting factor of year 1 plus C2, that means cash flow of year 2 is multiplied by the present value discounting factor of year 2 and so on till the nth period. And when the C is equal amount, let's say when cash flow is equally received over the period of holding with the regular interval, that's called annuity. So when there is an annuity, we can convert this formula into this. V equals to C times PVDFA for the Kn. So PVDFA is basically the present value discounting factor for annuity, which I have explained in detail in my another video for time value of money. How do we calculate the present value discounting factor for annuity? You can refer to that video. Now let's understand the bonds valuation. Bond or debenture value is equal to the present value of all future contractual payments which the bond holder or debenture holder is likely to receive from the bond issuer over the period of its holding, plus, so that becomes your interest received present value, plus he will also get the principal amount or the face value or the par value of the bond at the time of maturity. So that's called maturity value. So when we calculate the present value of that maturity amount and add the present value of interest amount, we get the total value of the bond. So we can put it in a mathematical formula like this. B is the bond value equals to I, which is the interest amount, annual interest amount which the bond holder is likely to get on the bond, which is nothing but coupon rate times the face value of the bond times sum of the all the future interest amounts discounted value, which is calculated by 1 divided by 1 plus r raised to power t. So this first portion is basically the present value of all future interest payments, which is likely to be received by the bondholder. This is added by the second section is called m times 1 divided by 1 plus r raised to power n. So m is the maturity value here, which he is likely to receive at the time of maturity of the bond, and which is discounted by 1 plus r raised to power n. N is the number of years to the maturity of the bond. From now, whatever is the number of years, so at that number of years with the required rate of return of the investors, that gets discounted. So this is the present value of the maturity amount. When we add both together, the total value of the bond is derived. So here we know that I is a constant figure because I is equal to the bond par value times the coupon rate. So I becomes an annuity amount. So we can also put this formula in this fashion, that bond value is equal to I times PVDFA, present value discounting factor for annuity, for the required rate of return and for the n period, plus M, which is the maturity amount, times PVDF, present value discounting factor for the R rate and the nth period. So let's take an example. If a company issues a bond which has a face value of $100 and coupon rate of interest rate is, let's say, 8% payable annually, and maturity period of the bond is, let's say, 10 years. So in this case, if the required rate of return of the lenders is, let's say, 10%, so which is higher than the coupon rate, so the value of the bond in this case will be the annual interest amount, which is $8, 100 times 8% times 6.1446 is the PVDFA factor at 10% interest required by the bondholder for 10 years. So that value is 6.1446. We can calculate this value either using the formula for PVDFA, which I have explained in my another video of time value of money, or we can simply refer to the PVDFA table, ready reckoner table, which is also there in that video, plus the maturity amount of $100, which will be receiving after end of 10th year. So the present value factor of that is 0.38883855. So the total value becomes 49.16 for the present value of all future interest and 38.55 for the present value of the redemption amount. So total value of the bond becomes 87.71. Now, if the interest rate required by these bondholders is 6%, which is lower than the coupon rate, in that case, PVDFA amount factor will be higher than the earlier one because of the lower discounting rate, and similarly, the PVDF factor also will be higher than the earlier one because of the lower discounting rate. So the value of the bond will become higher than the face value, 114.72. Now what happens if the required rate of lenders is 8%, same as coupon rate? In that case, applying the PVDFA and PVDF factor in the above formula, we get exactly the same amount, $100. Now what happens if the interest rate on coupon is semi-annual instead of annual payment? Normally coupons are paid semi-annually basis. So in that case, the basic fundamental concept remains same. Only thing is that R, which is the required rate of return by the bondholder, will be divided by 2 for the purpose of discounting, and interest amount, instead of annual it is received semi-annually, so I will also become I divided by 2, and the compounding, instead of t times compounding the discounting, it will become 2t because interest rate is received semi-annually, so the discounting has to be 2 times t period, and the maturity amount will also again, the r will get discounted by, will divided by 2 and raised to power 2n instead of single n. So we can say like that, since I is a constant factor, constant amount, so it becomes an annuity. So this formula can be converted to this I divided by 2 times PVDFA for R by 2 rate and 2N period plus maturity amount multiplied by the present value discounting factor for the R by 2 rate and 2N period. So taking the same example here, if the discounting rate is 10%, but it is interest is payable semi-annually, so the interest amount becomes 8 by 2, which is $4 every 6 months, and the R by 2 PVDFA factors becomes 12.4622, and the PVDF factor for the maturity amount becomes 0.3769 for 5% interest rate with 20 times discounting. So the value of the bond becomes 87.54. So same way we can calculate for 10%, 6% and 8%. At 8%, which is exactly matching with the R equals to coupon rate, the value of the bond will be exactly same, because the investors is getting exactly what is there in the coupon rate. So there will be neither discount nor premium to the bond value. Now, from the above examples, we can say that the required rate of return, which is the discounting rate or R, is one of the most important factor which affects the bond value. So, for example, when coupon rate is equal to the required rate of return of the lender, then the bond value will be always equal to the par value. There will be neither any discount nor any premium. When the coupon rate is higher than the required rate of return, let's say coupon rate here was 8% and the required rate of return is only 6%. So basically the borrower is paying higher than your required rate of return. In that case, the investors will be willing to pay some premium on the first face value of the bond. So that's why the bond value will be higher than the par value, and that difference between the face value and the bond value, which is the purchase price, is called premium. Conversely, if the coupon rate is lower than the required rate of return of the bondholder, that means coupon is not delivering the return which is expected by the bondholder, then the bondholder will have to buy at lower price, lower than the face value or par value of the shares, to match with his required rate of return on the investment. So that's why the bond value will be lower than the par value in this case, and the difference between the value of the bond and the face value is called the discount. Another important factor which affects the bond valuation is the time remaining or time left to the maturity. So the shorter maturity period means the interest rate risk will be lower, and the longer maturity means the interest rate risk is higher. So if the time left to the maturity is longer, the investors will require higher discounting rate to cover his interest rate risk, and that's why the value of the bond will also be proportionately lower. Now, another factor which we can say from this analogy is that lender's required rate of return is constant. When R is constant over the holding period, then the value of bond will tend to approach closer to its face value, as we go closer to the maturity. So when the required rate of return R is equal over the period, that times as we move approach near the maturity period, the value of the bond becomes more and more closer to the face value. Now, when the R is changing, the required rate of return of the investors is changing over a period of time, then the shorter the remaining time to maturity of the bond, the lesser it becomes responsive to the changes in the required rate of return. So as we move closer to the maturity period, the required rate of return change will have lesser impact on the bond value. So that means it will have less sensitivity to the valuation of the bond. And if the period is remaining is longer, then it will be more sensitive to the required rate of return change of the investors. Now let's understand the concept of yield to maturity. Yield to maturity is basically the rate of return which an investor earns if he or she holds the bond at a specified price and he holds that bond till its maturity. Like he doesn't sell in between. So whatever is the average return he will get on his purchasing price, that is called yield to maturity. So, for example, if the lender is buying the bond at face value, so neither he is paying any premium nor he is paying any discount. He is getting any discount. So, when purchase price is equal to face value, then a YTM will be always equal to the coupon rate, because whatever he is earning as a coupon on his purchase amount is his annual rate of return. Then, if the lender buys the bond at premium to the par value, since he has paid premium, so his average return will become lower than the coupon rate, because he has already paid the excess over the par value. So his coupon rate will not be sufficient. His actual YTM will be lower than the coupon rate. And if he buys the bonds at discount to par value, then his YTM will be higher than the coupon rate, because he has bought at a lower price. So his annual return on that investment will be higher than the coupon rate, because coupon rate is fixed and the interest amount he will continue to get on the face value, whereas his purchasing price is lower. So his yield on that investment will be higher if he holds the bond till maturity. Now, to calculate the YTM, we have to determine at what interest rate, using our PVDFA and PVDF tables, the lender's purchase value of the shares equals the future cash flows, which is basically the interest stream received on the amount plus the maturity value. So when the present value of these both two is equal to the purchase value of the bond, at what interest rate it becomes equal, that rate we have to find, and that rate is called the YTM. So we can put it in a formula like this: purchase price equals to interest times PVDFA at R n. So this R value we have to calculate. R is the value of YTM plus maturity price into PVDF for R and N. So this we have to, R value we have to calculate using the iteration process and interpolation method, at which the purchasing price of the bond equals the interest times PVDFA plus maturity value times PVDF for that particular R and for that N period. Now, when this iteration process is time consuming, we can do some quick approximation of YTM and then calculate the exact YTM using the above formula. So how do we calculate the quick approximation? There is a shortcut formula which we can use, which reads like this: the approximate YTM is F minus P divided by N, whereas F is the face value of the bond, P is the current purchase price of the bond. So when we do F minus P, this is either premium or discount. So if P is higher than the F, so that becomes premium. If P is lower than the F, that becomes discount. So that premium or discount is amortized over the N period. So N is number of years left to maturity. So that becomes the annual average annual premium or discount on buying the bond, plus I is the interest amount, annual interest amount. So that becomes average total income from that bond, and that is divided by F plus P divided by 2. F is the face value, P is the purchase price. So average of these two is the denominator, and this becomes the numerator. Let's understand this with a simple example. The face value of the bond is, let's say, $100. The current price at which the bond is getting sold is $110. So $10 is the premium on that bond. Coupon rate payable annually is, let's say, 10%. So bond will pay an interest of $10 every year on $100 face value, and years left to maturity is 6 years left. So what we have to do, numerator F minus P divided by N. So this $10 premium what we have paid to buy that bond have to divide by the remaining number of years to the maturity, 6. So 10 divided by 6 is 1.6667 plus interest is $10. F times C. C is the coupon rate. So 10 plus 1.6667 becomes 11.6667 as the annual return on an average, divided by the denominator is F plus P divided by 2, that is 100 plus 110 divided by 2, so 105. So if we divide 11.6667 by 105, we get the YTM of 11.11% approximately. Now, when we have to calculate the semi-annual yield to maturity through quick approximation method, that time the concept and fundamentals remain same, except that I, which was annual interest rate, gets divided by 2 because of the semi-annual, and N, which was an annual number of years left to the maturity, is multiplied by 2. That becomes number of half yearly period left to maturity, and rest of the things remain same. So in this formula, $10 premium will get amortized over 12 half yearly periods, 6 times 2, so n times 2, so that becomes 0.8333, and the annual interest rate will get divided by 2 to become half yearly interest. So F into C divided by 2, that becomes 5% for half yearly. So 5 plus 0.833 becomes 5.833 as total half yearly return on the bond, and that is divided by $105 of investment on an average. So half yearly YTM, half yearly or semi-annual YTM approximately comes to 5.56%, and we can convert the half yearly YTM to yearly YTM by using this formula: 1 plus semi-annual YTM raised to power 2. So if we do that, 1 plus 5.56 raised to power 2 becomes 11.42 exactly. Or if we have to calculate the approximate YTM, we can simply half yearly YTM we can multiply by 2 to get 11.12%. This is how the concept of YTM and bond value is explained. Thank you. For preference shares valuation and equity shares valuation, I have created separate videos. If you like, you can share this video with your friends, and many other financial management topics and statistical concepts I have covered through separate videos. So if you want to have a look at it, you can refer to my channel. Thank you. Bye.